You've studied the accumulation pattern perfectly. The spring shook out the weak hands. The test showed strength. Every sign pointed to markup, yet you sold at the first sign of resistance. 3 days later, price explodes 40% without you. This isn't bad luck. It's a systematic error in reading the composite operator's true intentions during the critical sign of strength phase. For example, last month, I identified a textbook accumulation schematic in a pharmaceutical stock. Volume dried up beautifully. The spring came at $23, followed by a successful test at $24. When price reached $27, my original resistance target, I took profits, convinced the markup would stall. Within a week, it cleared $38. I had read the preliminary supply correctly but failed to recognize the backup action was actually the composite operator's final test before the major campaign. Let me tell you something that has cost more traders their fortunes than perhaps any other single error in judgment, the inability to distinguish between a sign of strength and the actual markup campaign itself. When a stock has been under accumulation for weeks or months, confined to a narrow trading range, the public grows weary. They've watched it go nowhere. Their capital is tied up. Then suddenly, on increased volume and wider spread, the stock breaks out of this range. The tape shows strength. Orders are coming in. This, my friends, is what I call the sign of strength, but it is not the markup. Here's where the amateur makes his fatal mistake. He sees this initial thrust, this first demonstration of demand overwhelming supply, and he thinks, aha, this is it. This is the big move. He rides it for a few days, perhaps a week. The stock advances nicely, maybe 5 points, maybe 10. Then it encounters resistance, perhaps an old supply level where stock was distributed months ago. The advance slows, volume diminishes slightly. And what does our amateur do? He sells. He takes his profit, congratulates himself on a successful trade, and moves on to the next opportunity. But what has he really done? He has sold his stock to the very operators who spent months accumulating it. He has handed his position back to the composite operator at the precise moment when the real campaign is about to begin. You see, the sign of strength serves a specific purpose in the operator's plan. It is a test, a demonstration to themselves that their accumulation has been successful, that they have indeed absorbed the floating supply, and that the stock is now ready for markup. But more importantly, it serves to attract public attention and to shake out the weak holders who bought during the latter stages of accumulation. The composite operator knows human nature. They know that the average trader lacks patience. They know he will sell on the first decent rally, happy with his small profit, never imagining that the stock he just sold for a 5-point gain will in 3 months' time be 30 or 40 points higher. The true markup, the sustained campaign that the operator has been preparing for, doesn't begin until after this sign of strength has done its work. It begins after the subsequent reaction and test, when the stock pulls back and finds support, demonstrate that there are now buyers willing to absorb supply at higher levels than during accumulation. This backup, this last point of support, as I call it, is where the operator completes their final preparation. When you see a sign of strength, don't ask yourself, should I take my profit? Ask instead, would an operator who spent 3 months accumulating this stock be satisfied with a 10-point markup? The answer, of course, is no. Their cause is far greater than that. And if you can learn to think like the operator rather than react like the public, you'll find yourself holding through these initial tests and participating in the real campaign that follows. Now, I want to address what I consider the most reliable indicator available to the tape reader: volume in relation to price movement. If you master nothing else in your trading career, master this, and you'll have an advantage over 90% of the people who speculate in stocks. When a stock rallies on your initial sign of strength, and then approaches resistance, that old supply level where previous operators distributed stock to the public, you must watch the volume with the intensity of a hawk watching its prey. This is the critical juncture. This is where fortunes are made or lost, not by what happens, but by your interpretation of what happened. Let me give you the scenario that traps most traders. The stock rallies into resistance, volume increases, the spread narrows, price hesitates. The amateur sees this and thinks, the big boys are selling, this is distribution, I must get out now. So he sells, and he sells at precisely the wrong moment. But what is really happening? Let me explain what volume actually tells you at resistance. When a stock meets supply and volume increases while price barely advances or even declines slightly, you must ask yourself, where is this volume coming from? Is it coming from the operators distributing their holdings? Or is it coming from the operators absorbing the supply that appears at this level? Here's the key distinction, and I want you to burn this into your mind. If the operators were distributing, the stock would break sharply on heavy volume. They have too much stock to sell. They cannot distribute their entire line at one price level. The very act of their selling would drive the price down rapidly, creating wide spreads to the downside. But when you see heavy volume with narrow spreads and the stock holding firm perhaps declining only fractionally or even remaining unchanged, this is absorption. The operators are buying every share that comes out. They are removing the supply overhang that has existed at this resistance level. They are doing the public a service by cleaning up the old supply, though the public is too blind to recognize it. I've watched this pattern repeat itself thousands of times. The stock works at resistance for several days, sometimes a week or more. Volume remains good, but not spectacular. The price spread is narrow, no dramatic plunges, no panic selling, just methodical trading. Then, almost imperceptibly, the volume begins to diminish. The supply dries up. The operators have absorbed it all. What comes next? A rally on increasing spread and moderate volume as the stock moves through the resistance level as if it were never there. And where is our amateur trader? He's on the sidelines, having sold his position days earlier, watching in agony as the stock does exactly what he hoped it would do, but without him. Compare this to genuine distribution at a top. There you'll see increasing volume with widening downside spreads. You'll see the stock unable to rally. You'll see each successive wave of selling taking the price lower and lower. That's the operator getting out, not getting in. The resistance during markup? Watch for absorption, not distribution. The difference in volume behavior will tell you everything you need to know if you'll take the time to read it correctly. There's a phenomenon I've observed countless times in my years of studying market behavior, and I've given it a name that I believe captures its essence perfectly: the backup to the edge of the creek. This is perhaps the most psychologically challenging moment in the entire markup campaign, and it's precisely where the majority of traders abandon their positions just before the explosive advance they've been waiting for. Picture this: you've held your stock through the sign of strength, you've watched it rally nicely from the accumulation area, perhaps you've made a paper profit of several points. Then, just when everything seems to be going according to plan, the stock begins to react. It gives back some of its gains. The tape shows selling. Your profit diminishes. Doubt creeps into your mind. This, my friends, is the backup, and it is absolutely essential to the operator's plan. But the public doesn't understand this. They see weakness where there is actually strength being demonstrated. Let me explain what's really happening. After the initial sign of strength, the stock has attracted attention. Some of the public has bought. Some weak holders who purchased during late accumulation have been shaken out. The operators now need to test the stock one final time before launching their major campaign. They need to see if there are still nervous holders who will sell at these higher levels. They need to verify that their absorption has been thorough. So they allow the stock to react. Sometimes they actively encourage it by withdrawing their support temporarily. The stock drifts back down, perhaps retracing half of the advance from the sign of strength, sometimes more. It comes back to what I call the edge of the creek, that last point where support will be found before the real markup begins. Now here's what separates the professional from the amateur. The amateur sees this reaction and panics. He thinks, I was wrong. This isn't going up after all. I'd better sell now before I lose everything. He sells at the very area where the operators are making their final purchases, the very point where the strongest hands are accumulating from the weakest hands. The professional on the other hand, recognizes this backup for what it is. He watches the volume carefully. If the volume diminishes substantially on this reaction, and it usually does this, tells him that there's no real selling pressure, no distribution taking place. The stock is simply drifting back on lack of demand, not being forced down by aggressive selling. When the stock finds support and holds at this level, testing it perhaps 2 or 3 times without breaking down, he knows the creek's edge has been found. What happens next is what makes this principle so valuable. After this final test, after this last shakeout of weak holders, the stock begins its real advance. Not the preliminary sign of strength, but the actual sustained markup campaign. And this advance is usually far more powerful than the initial rally because all the preparatory work has been completed. The operators have their full line, the weak holders are out, and the path of least resistance is now firmly upward. I cannot emphasize this enough. If you sell at the backup to the edge of the creek, you will never participate in the major moves. You'll be perpetually getting in and out at exactly the wrong times, selling at the last point of support. Just before the explosive advance, that was your goal all along. I want to introduce you to one of the most powerful yet overlooked principles. In all of stock market analysis, the relationship between cause and effect. This principle alone can save you from the costly mistake of exiting a position prematurely because it gives you a mathematical framework for determining how far a stock should travel once it begins its markup campaign. The cause is the accumulation. The effect is the advance. It's as simple as that, and yet most traders completely ignore this relationship. They see a stock rally 10 or 15 points and think, well, that's a good move. Time to take profits. But they never stop to ask themselves, was sufficient cause built during accumulation to justify only a 10 or 15-point advance? Or was the cause large enough to support a much more substantial markup? Let me explain how I measure this. During the accumulation phase, I maintain a point and figure chart of the stock's behavior. Each day that the stock trades within the accumulation range, each swing up and down within that congestion area adds to the cause being built. The longer the stock remains in accumulation, the greater the cause. The wider the trading range during accumulation, the greater the cause. The more back and forth action within that range, the greater the cause. Now here's the critical insight. The amount of cause built during accumulation determines the potential effect in the subsequent markup. A stock that has been under accumulation for 3 months can support a much larger advance than a stock that has been accumulated for only 3 weeks. This isn't mystical, it's mathematical. It's based on the simple fact that operators don't spend months tying up their capital to accumulate large lines of stock for small profits. I've developed a counting method using point and figure charts that allows me to estimate the minimum objective for the advance. Without getting too technical, the principle is this. Count the number of columns in your point and figure chart during the accumulation phase, measure the width of the trading range, and you can project a price objective for the markup campaign. Here's where traders make their fatal error. They exit based on their own limited profit objectives rather than on the cause that has been built. A trader buys at 40, sees it rally to 50, and sells happy with his 10-point profit. But if that stock was under accumulation for 4 months in a 20-point range, the cause built during that period could easily support an advance to 80 or even 100. By selling at 50, he's captured perhaps a quarter of the move he should have participated in. Think about it from the operator's perspective. Would you spend 4 months carefully accumulating a stock, tying up millions of dollars, dealing with all the complexities of absorbing supply without driving the price up, just to make a 10-point profit? Of course not. The operator's objective is proportionate to the effort and time invested in the accumulation. This is why I insist that every serious student of the market must learn to keep point and figure charts and must understand the cause and effect relationship. Without this knowledge, you're simply guessing at when to exit. With it, you have a rational, objective basis for holding your position through the entire campaign. When you find yourself tempted to sell after a modest advance, pause and ask yourself, have I given this stock enough time and price movement to fulfill the cause that was built? More often than not, if you're honest in your analysis, the answer will be no, and you'll save yourself from the agony of watching the stock continue upward without you. I'm going to share with you now what I consider the most transformative mental shift a trader can make, one that has rescued more of my students from chronic failure than any other single insight. It's this: stop thinking about your position and start thinking about the composite operator's position. What do I mean by this? Let me illustrate with a scenario that plays out every single day in the market. You've purchased a stock at 45 during what you correctly identified as accumulation. The stock rallies to 55 on the sign of strength. You're pleased you've made 10 points. Now the stock approaches 58, an old resistance level, and you begin to feel anxious. You think to yourself, I've made 13 points. That's a nice profit. Maybe I should lock it in before it reverses. This is natural human thinking, but it's also precisely why most traders never achieve substantial success. You're thinking about your position, your entry price, your profit, your anxiety, but the composite operator isn't thinking about any of that. Let me tell you what they're thinking about. The operator began accumulating this stock months ago, let's say at an average price of 42. They've spent perhaps 3 or 4 months carefully buying every share that came available, absorbing supply, shaking out weak holders, conducting tests. They've tied up enormous capital in this position. They've accumulated perhaps 100,000 shares. Maybe more. Their entire line represents an investment of over $4 million at their average cost. Now ask yourself this crucial question: would an operator with that kind of capital commitment, who has invested months of time and effort, who has gone through the entire accumulation process, would such an operator be satisfied with a profit of 13 or 14 points per share? Would they distribute their entire line at 58, making perhaps $1.6 million on a $4 million investment after all that work? The answer, when you frame it this way, becomes obvious. Of course not. The operator's objective must be proportionate to their effort, their capital, and the risk they've undertaken. If they've built sufficient cause through months of accumulation, their target is likely 75, 85, perhaps even 100 or beyond. They're not thinking about exiting at the first resistance level. They're thinking about the campaign that lies ahead, the full markup phase that will justify their enormous undertaking. This is the mental framework you must adopt. When you feel the urge to sell at 58, don't ask yourself, should I take my profit? Instead, put yourself in the operator's position and ask, if I had accumulated this stock at 42, would I be distributing now at 58? When you frame the question this way, the answer becomes clear, and your anxiety transforms into conviction. Here's another critical consideration. What is the operator's cost basis compared to yours? If you bought at 45 and they accumulated at 42, you're in essentially the same position they are. You're both holding at a profit, though yours may be slightly less. When you're anxious about a small pullback from 58 to 55, remember, the operator is still showing a 13-point profit at 55. Do you really think they're panicking? Do you think they're rushing to exit? The composite operator has staying power that you lack only if you allow fear to dominate your thinking. But if you align your thinking with theirs, if you understand their position and their objectives, you suddenly acquire that same staying power. You're no longer trading your emotions, you're trading their plan. I've trained myself over decades to think this way, and I encourage you to do the same. Before you make any decision to exit a position, stop and visualize the operator's situation. See their accumulated position, their average cost, their capital commitment, their time investment. Then ask yourself honestly, would they be exiting here? 9 times out of 10, when you think like the operator rather than like the anxious public, you'll make the correct decision, and that decision is almost always to hold through these temporary moments of doubt and participate in the full campaign they've so carefully orchestrated. Gentlemen, we've covered considerable ground here today, but I want to leave you with this final thought, one that I hope will stay with you long after you've left this room. The early exit is not a matter of bad luck. It's not about the market being against you. It's not even about picking the wrong stocks. The early exit is a systematic error in thinking error that stems from viewing the market through the lens of your own fears and limited objectives rather than through the lens of the operator's plan and purpose. Every principle I've shared with you today points to the same fundamental truth. Successful speculation requires you to think differently than the crowd. When the public sees the sign of strength and sells on the first rally, you must recognize it as just the beginning. When they panic at resistance, you must read the volume and see absorption, not distribution. When they abandon their positions at the backup to the edge of the creek, you must recognize it as the final test before the real advance. When they exit after small gains, you must consult your point and figure count to see if sufficient effect has been produced from the cause that was built. And above all, when your emotions scream at you to sell, you must step back and ask yourself, what would the composite operator do in this position? These are not mere theories I'm presenting to you. These are principles I've proven through decades of observation, through thousands of trades, through both painful losses and extraordinary victories. I've made the mistakes I'm warning you about. I've sold at the backup. I've exited at resistance. I've taken small profits only to watch stocks continue dramatically upward. And through each of these experiences, I've learned to recognize the patterns, to read the tape more accurately, to think more like the operator and less like the anxious public. The tools are available to you: the sign of strength, volume analysis, the backup principle, point and figure counting, operator thinking. But tools alone are worthless without the discipline to apply them and the courage to trust them when your emotions are telling you otherwise. I won't tell you that applying these principles is easy. It requires study. It requires practice. It demands that you maintain detailed charts, that you watch the tape with unwavering attention, that you constantly ask yourself what the operator is doing rather than what you want to do. But I will tell you this. The difference between the trader who consistently exits early and the trader who participates in the full campaign is not talent, and it's not luck, it's methodology. You now have the methodology. The question is, will you have the discipline to follow it? Will you hold through the backup when every instinct tells you to sell? Will you trust the cause and effect relationship when a small profit seems safer than waiting for the larger objective? Will you think like an operator when it's so much easier to think like the public? Your future results will answer these questions. I hope, for your sake, that the answer is yes, because I can assure you of this. Master these principles, apply them with discipline and patience, and you will never again watch in agony as a stock explodes 40 points without you. You'll be there for the entire campaign, participating fully in the moves you worked so hard to identify, reaping rewards proportionate to your effort and your capital just as the operators do. The choice, as always, is yours. Trade well, think clearly, and remember, the operator's plan is unfolding whether you participate in it or not. The only question is whether you'll have the wisdom and courage to stay with it.